Welcome to StockOdds Odds and End podcast. I'm Dave Singh here with Rob Friesen. Good evening, Rob. How's everything?
Not too bad. Just so thankful. Don't have to deal with all the storms and stuff that some places are getting. We've kind of gone from more of a quiet. I thought they were saying that there probably wasn't going to be that many hurricanes, but now we're certainly seeing them start to come up there.
What's rain you speak of? I'm from California.
But look at the typhoons that are going on, over towards Japan and Asia and stuff like that. And then we've got, hurricanes, the one that just pounded all the way up through Bermuda and into eastern provinces of Canada. That's really been pounded, the four Atlantic provinces. And then now you got Hurricane Ian coming up, probably going to be a direct hit into Florida. So, it's hurricane season is still alive and well, and the ocean temperatures are pretty high. So I think that can carry a lot more activity when that happens. But what's your thoughts?
Well, at least the markets are calm, right?
Well, yeah, at least the markets are. Well, actually, the VIX is, speaking of that, the VIX has risen back up into the 30 area. So we were quieter, getting down towards 20. And then we had that, like, it was so calm there into August that we were kind of like, well, we're kind of expecting a bit of a turn. And sure enough, middle August, it pops up to 23 and then grinds its way all the way up now to 30. So it's not as high as we had through March, April, May, but you're not far off.
Yeah.
And then the currencies are what are mind-boggling, right? When you think of, like, you have to go look at a chart of the monthly on the U.S. dollar, because on one of the shows here, I think last week even, we mentioned that wouldn't be surprised if it went back to the highs, the strength of the dollar as we were in 2001, 2002.
It's like a parabolic chart.
Yeah, I wouldn't be surprised because we were already pushing into that air pocket. Once we took out the highs from 2020, which was COVID induced, right? Mm-hmm. Once we took out that high, which was a matching high, by the way, to what we had in 2017, we took that out. I thought, this is kind of like a blue sky moment here. And we've got nothing in terms of resistance until we get to 2001, 2002. Well, what a difference a week makes. We powered up, and just like somebody used the word unprecedented hurricane hits the eastern seaboard of Canada. This is an unprecedented move in currencies. You take a look at the euro trading, it's not all the way back to the lows from 2001, 2002, but it's closing in on it rapidly, right? Japanese yen is right back to the low from 1999. Well, not quite. We're just about there. Can you believe that? British pound is into new lows. The cable here is just collapsing these last 2 months. And then Canadian dollar is lower, but still got quite a ways to go. Lots of support levels still to test. Swiss franc, stable, sideways, and still elevated historically. Australian dollar, similar to the Canadian dollar, and same as New Zealand dollar. So, but the big standouts, of course, are the U.S. dollar and then the British pound and the euro dollar. Those would be the big standouts, right? So, am I still coming through okay?
Yeah, you're good. And the 10 years up to 3.72 as well. It keeps rising.
Yeah, these bonds are just, unbelievable sell-off in the 30-year, 10-year, 5-year. I mean, the 2-year is the most dramatic. 2 and 5, of course, are more sensitive than the longer term. But yeah, just collapsing at an incredible rate, which is going to be very disruptive. I mean, when we look back to other times when this has occurred, there has been systemic fallout from that. I mean, if we the interesting thing about the 2-year and 5-year and so on is that we came from such incredible highs in 2020, and from that point we have just been literally straight down. I mean, hardly a bounce at all. So it has to impact things. I mean, now what's going on in metals? With all the trouble in the world, gold and silver is certainly not, showing us anything in terms of defensive desire, really. We've collapsed off of our highs from 2020, 2021, 2022 at the beginning, and we're now taking out the 3-year support levels on gold. We already did a while back on silver. Now we had a reasonable few days in silver, but overall the big picture is still pretty much down. Copper is one of those things you have to look at related to the fears of recession, global recession especially. Even in spite of this EV, electrified world and all the green technologies and all of that agenda, we're still seeing copper decline, and it's that global recession theme that is powering it, I would think. So copper is, I mean, so important in industry, so important in the EV world, right? So now let's look at our indices. You still there?
Yeah.
Okay. So we've got Dow Jones off 117 points or 0.39%. S&P is off 16.25 or 0.44%. NASDAQ 100 off 39.25 or 0.35%. Russell is off 7.90 or 0.47%. DAX is off 53.43%, and the VIX tonight is up 0.69 or 2.31%. So that's the lay of the land here. We're still factoring in this drop here. What's interesting is the Dow Jones did take out the June low. S&P is kind of at the door. Same with NASDAQ. Russell had such a bad day for the last couple days here that it caught up pretty quick, and it's pretty much at the door. So that June level is still in play as far as a potential support level for the S&P, NASDAQ, and Russell, but not the case for the Dow Jones, which is interesting, don't you think? Because it's price-weighted index, it's not market cap-weighted index. It's also more defensive at large, and yet it's the one that already took out its June low. So I find that interesting.
Or what's the next level if we break that?
Well, we are
February 2020 high.
We're kind of we took out that June low, and now we're sitting, just to get my bearings here. The low was 293.15, and the high of this one. Well, we're closing in on the high from 2020 before we went down into the COVID slide, right? Mm-hmm. So we're just about there. And if that former resistance or price point doesn't become support, then I would say the consolidation level, which has a lot of matching numbers, both highs and lows, would be about the 26,000 level on the Dow. So let me put the diamonds in here and give you that number, because you're probably referring to the ETF in your mind a lot more. So that would be 265 area. So 260 to 265,
Mm-hmm.
and it's currently at 295, right?
Mm-hmm.
So I mean, we've got this situation where we've pulled back from the high a reasonable amount. Everybody says, well, that's the correction territory. Now we can bounce. Now we can go from here. You've seen a lot of people put out stuff to say this is the buying opportunity of the next 10 years. And it very well might be, but also the bottom might not be in at the same time, because I don't think the market had factored a lot about the global recession, the impact of that on corporate profits and all these things, because we were more in inflation will peak at some point. The Fed is raising interest rates to tackle it. We'll have a softer landing. I mean, I'm just talking about the narrative that was out there. We'll have a softer landing. We'll be able to skirt the recession. We won't really go into a long, prolonged one or a deep one. But I think realities are coming into the forefront now, and the market is factoring that in. So I think it's very conceivable, just as we've talked about before, different biases that we have based on the knowledge that we gain from digging around and looking at that next most likely place that something would gravitate towards. So I'm gonna chalk it up at anywhere from the 250 level on the diamonds to the 265 would be my target. Going to the SPY, I would be looking at the next real place to test would probably be in the 320 to 335 area, somewhere in there. That would be the next one I would be thinking about. So we're already on the lower Bollinger Band. We're coming up where 350 is the 50 period moving average on the monthly. Let me just see what it is on the daily. We're below it on the daily. So on the monthlies, if you're looking at moving averages, at 350 level would be the 50 period, so 50-month moving average. So yeah, there's definitely room to move to the downside. Looking at the Qs, we're really at an incredible support level with that June low, but just below the June low is also some of the pullback that we had after we rallied off the lows in 2020. So we kind of had the COVID time. We rallied out of that. We had incredible NASDAQ rally. Then we pulled back a little bit and consolidated. So right below where we are is that support from that consolidation. And if that doesn't hold, then it's heading back towards the high from 2020, which was 237, and most likely probably to target the 200 level on the Qs. So if you think we've already fallen substantially, another third of that move to the downside is still very possible.
Wow.
Okay.
It's a huge movement.
Yeah, I mean, we have to allow for it. I mean, we're going into the most volatile month of the year, which is October. We're ahead of the midterm elections. We still have lots of concerns with the war. We have other bad actor nations kind of rolling up to play in the party as well. So I think we were best to be on the defensive. That's my posture, is a real defensive period of time until all this stuff flushes out.
Mhm.
And at the same time, I'm well aware that, when it looks the scariest, and historically, and before something is completely flushed out, can often be the time to buy. But then you do have to, take that risk that you might be still early. That's what happens to a lot of buy the dippers, is they get in there because of a nice discount and they're early.
Yeah.
And they get run over for a while, right? Now, if you have lots of cash, to, handle that, okay, fine. If you're long term, maybe 10, 20 years, that's fine. But if you're trading short term, or you're trading leveraged or whatever, you have to be much more on point with the timing, and you can't afford, a significant drawdown like what is still possible here.
Yeah.
So what do we have for the seasonality? We're just rolling into the last 5 days of the month.
Yeah.
So what would be important is, the seasonality for this week and the last trading day of the month.
Yeah.
And then the next Sunday we can tackle the first trading day of the month seasonality, I think.
Yeah. Well, for September, again, most of the month is down except for the last 5 days, last 3 days, and last day of the month. So we're expected to have plus 0.14% for the 5-day window for the spider. And the Qs are expected to do a little bit better, plus 0.54%. Diamonds are about the same as the spider. And the IWM is expected to do poorly, minus 0.37%. So stronger things like NASDAQ, weaker things like the Russell 2000. And then within that, I looked at some of the ETFs. SMH, the chips, expected to do 1.38%. TAN, solar stocks, 0.79. And some other ones that are expected to be stronger are XLK, XLC, XLY, so discretionary, utilities, technology. Those are expected to do a little stronger in that window. And things that could be weaker are biotech, XBI, IBB. XBI is expected to do minus 2.27%. So that, coupled with the increase in the 10-year, is a good backdrop, right? You have seasonality in your favor for being shorter biotech. It's going to also get crushed by the increase of interest rates. So some biotech is good to short. And then we've got gold weaker than normal, minus 2.23, and silver weak. Real estate, the IYR, minus 0.71, and healthcare. So there might be some interesting plays in terms of sector against sector there. And then I also looked at the economic calendar. Nothing too major this week. On Tuesday, there are some things about durable goods, orders, consumer confidence, and new home sales. And then on Thursday, initial jobless claims, which could drive the market. And then Friday, producer price index. The jobless claims would be nice because if we can see a crack in the job market, that would be supportive of the Fed not having to be so aggressive. But up till now, jobs have held in there. So Thursday could be interesting in terms of jobs numbers. But that's it so far here.
Well, a little bit of news in the crypto space. I mean, Bitcoin US dollar relationship is sitting just on its highs from 2017. So, I mean, it's been uncannily sideways, almost as if it's synthetically supported. I just find it odd. This whole area between 18,000 and sort of 25,000 is a range that it's been in. So it's definitely traveling sideways, but it just seems to constantly be stuck here, which is a little bit strange to me. So there may be a reason for that, but just could be, what is. But if we break out, either way, so if this level fails to hold, I mean, I could see it heading back towards 10,000.
Mm-hmm.
So, like, you know what I mean? It's almost synthetically stable at the moment.
It doesn't have many periods where it's sideways. It's either shooting straight up or shooting straight down for the most part.
Yeah, it is kind of strange, right? So I'm just going to leave it at that. But what else we got going on? I had this thought. I used to say in the BTM group years ago, it was a funny saying, the money's at the end of the move. Do you remember that saying I used to have? It's kind of a weird one. What does that mean? The money is at the end of the move. It's like when you look at some of these trends, like with the US dollar. So let's say you were long the dollar and you were exploiting that. You can use an ETF like UUP to play the dollar, right? So you're in the trade and it's just going parabolic. It's going straight up. And that's where the payoffs in those kind of trades, either for things that are going straight up like they are, or things that are going straight down, it's like it takes a while for things to start plodding along in a certain direction, and they have a battle and they finally start breaking through, and then it's like they really start gaining momentum, and then you start to see the dominoes falling, at a much rapid rate. And it's like the people that are wanting to buy that say like, oh, I'm missing the trade, I got to get in that. So they're in there. And then you got people that are like, oh, I was taking the opposite approach. I thought the dollar would die, or I thought this or that. And so they've got to unwind their positions. And that's why the money's kind of at the end of the move. It's like it takes a while to get that momentum. Once it does, it really moves fast and furiously until it comes to an end, right? So the money's at the end of the move, more so than in the beginning of the move. And I'm seeing that with the dollar and the pound and the euro. And I just wonder, when this thing is going to, it's like, what, like with the dollar, what's going to be the rug pull event that suddenly just causes the dollar to switch direction and start collapsing? I don't know, but that's what I'm concerned about. It's sometimes hard to put into words sort of the impressions that you get from just looking at everything, right? And kind of having a certain like alertness or awareness or concern. It's just hard to put into words why it might be, or what the ramifications, or what's going to cause it. But anyway, I'd be standing guard to say at some point this dollar, rallying against every other currency in the world, what's going to cause it to change direction?
Yeah.
And how rapidly would that descent be, and what are the implications of that? Because it's certainly creating stress on a lot of things as it moves now, right?
And even on the inflation in other countries, right? It's exacerbating their effect on them.
Yeah, absolutely. So the macro is alive and well. Technical trading is still alive and well, in the sense that I'm not talking about being necessarily a chart reader that can figure things out, but just your price levels, your VWAP, which is more mechanical than it is a technical indicator. Your previous close, previous highs, previous lows, all those things come into play in a market which there's a lot of unknowns, there's a lot of concerns, there's a lot of algorithmic trading, and I'm seeing that blend of macros alive and well, technical trading's alive and well, mathematical trading's alive and well, and statistical trading has been holding up pretty well, in spite of the fact that you have to draw statistics from the past. So there's kind of like short sample, long sample, and when you take both into consideration, I think it's holding up remarkably well when we're using the word unprecedented constantly, or so I'm pretty happy with having the 6-pillar approach where we look at macro, we look at fundamentals. We know that sometimes there's a flight to, more quality, more defensive stuff. I like having, technical and price and indicator levels. I like having, the sentiment aspect too, and historic relationships. So just putting it all together, I think we're going to have a great fall trading. Usually from my perch, I've seen traders do really well in October and November, and a lot of times November, December, after you get out of the chaos in October, you can see good breadth of the market, which helps people too. Sometimes small caps. Remember last year? I remember all those the small cap positions I took there. First trading day of November.
Yeah.
It did its performance for the month in the first day. So you got to keep your eye on that too, where small caps could be a little bit softer until September or October, and then or November, sorry, and take off then. So anyway, I think we babbled enough here, so I'll let you go.
All right. Good luck.
Yep. Take care.